Welcome to the deep dive. Today we're jumping straight into something really fundamental if you're looking to build wealth.
Yeah, how to actually put together, construct an investment portfolio.
Exactly. We've looked at what really counts, and, well, we're here to give you a clear, no-nonsense guide on how a solid investment plan actually takes shape.
Think of it as like your shortcut to understanding how to build and manage your investments the right way. We've got some, frankly, eye-opening stuff here that really boils down the core concepts.
Right.
And our goal is just to arm you with the knowledge you need to invest confidently without getting bogged down in all the jargon.
Totally. Because whether you're doing it yourself or, working with an advisor, understanding this process really pulls back the curtain on why certain decisions get made.
Mm-hmm.
We even found some surprising things about how the pros approach this, so yeah, get ready for maybe a few aha moments.
And it all really comes down to having a structured approach. Investing without a plan, it's like trying to build a house without any blueprints. It just doesn't work well.
Good analogy.
So today, we're really focused on making sure you grasp the essential steps, from laying the groundwork right through to keeping things aligned with your goals long term.
Okay, let's unpack this then, and where else to start but, well, the foundation. Asset allocation. What is that, just in simple terms, and why is it so important?
Okay, asset allocation. At its core, it's really just about how you divide up your investment money across different categories or buckets.
Buckets, okay.
Yeah, think of it like planting a garden. You wouldn't just plant, say, tomatoes, right? You'd probably want some vegetables, maybe some flowers, perhaps some herbs. Diversification.
Right, a mix.
Asset allocation is kind of similar. You're spreading your money across things like bonds, which tend to be a bit more stable, equities, which are stocks, offering more growth potential, and maybe some cash.
And there are smaller buckets within those.
Exactly. Within those big categories, you have subclasses. So bonds could be, say, government treasury bonds, or maybe corporate bonds from companies. And equities, well, that could be large cap stocks from big established firms or small cap stocks from newer, smaller companies.
So it's really the big picture view of where your money is going, not just obsessing over picking the next hot stock.
Precisely. And here's the real kicker, the thing that often surprises people. Study after study shows that over the long term, this initial decision, how you allocate between these broad asset classes, has a much bigger impact on your portfolio's overall return than, say, picking individual stocks or bonds within those classes.
Really? How much bigger?
We're talking like upwards of 90% of your long-term performance variability can often be traced back just to that initial asset allocation mix. It's huge.
Wow, okay. That really puts it in perspective. Getting that allocation right is, well, it's pretty much the most important first step.
Absolute fundamental.
Now, I've heard this term correlation thrown around. What does that actually mean when we're talking about different investments moving?
Correlation, yeah. It's basically a measure of how closely two different investments tend to move in relation to each other.
Okay.
Think of it like two dancers. A correlation of +1 means they're doing the exact same steps perfectly in sync. A correlation of -1 means they're doing the exact opposite moves. And 0 means their moves are totally unrelated, completely independent.
So it's measured on a scale?
Yep, using something called a correlation coefficient, which ranges from -1, perfect negative correlation, up to +1, perfect positive correlation.
Okay, so if two things have a high positive correlation, like close to +1, they basically rise and fall together.
You got it. Now, for your investment garden to really thrive and be resilient against different conditions, what we call diversification, you ideally want to include assets or plants that have low or even better negative correlation with each other.
Why is that?
Well, if one part of your portfolio takes a hit, another part that moves differently might hold steady or even go up, cushioning the overall impact. It helps smooth out the bumps.
Okay. So it's like making sure your whole portfolio isn't vulnerable to the same, I don't know, economic weather?
Exactly. And this is a really important but, these relationships, these correlations, they aren't set in stone.
Right. I've heard that too. They can change.
They absolutely can. The way different investments relate to each other can shift over time, especially depending on what's happening in the wider economy or markets. What used to zig while something else zagged might suddenly start moving together during, say, a crisis.
So you can't just rely on historical data forever.
Precisely. Looking at past correlations gives you a starting point, but you have to be aware that things can and do change. You need to keep an eye on it.
Okay, so asset allocation is the crucial starting point, but it's not static. It sounds like there's a whole process for managing this stuff over time.
Absolutely. Portfolio management isn't a one-off event. It's really a continuous process, like a loop with several key stages you cycle through.
Okay, so walk us through that loop. What are the main steps involved?
Generally, it boils down to about 5 key steps. First, you develop something called an investment policy statement, the IPS. Think of that as your financial roadmap or GPS.
Got it, the IPS. Step 1.
Step 2 is studying the current financial and economic conditions and trying to form expectations about the future, market trends.
Okay, looking at the environment.
Third, you actually construct the portfolio, building it based on that IPS roadmap and your market forecasts.
The execution part.
Fourth is performance measurement and evaluation. You've got to track how things are actually doing.
Makes sense. Checking the results.
And fifth, and this is crucial, is periodic review. You constantly monitor and review everything to make sure it's still consistent with your objectives and reflects any changes in your life or in the market conditions. Then you loop back.
So it really is a cycle. Plan, execute, feedback, adjust, and then repeat. You mentioned that investment policy statement, the IPS being step 1. That sounds pretty foundational. What exactly is it, and why is it considered so important?
The IPS really is the cornerstone, you could say. It's essentially your written plan, your personalized roadmap that guides the entire investment process. It's a document, usually something you create, maybe with an advisor, that clearly lays out things like your investment goals, how much risk you're comfortable taking, any constraints or limitations you have, and maybe even specific preferences.
So it's like setting the ground rules before you even start investing. Why is having this written down so critical?
Oh, it serves several really vital functions. First off, it helps you set realistic expectations about the kinds of returns you can reasonably shoot for. It's a reality check.
Right.
It also gives whoever is managing the money, whether it's you or a professional, clear instructions on how to invest in a way that actually aligns with your specific needs and objectives.
So it keeps things on track.
Exactly. Plus, it provides a framework, a benchmark for evaluating how well the portfolio is actually doing later on. And, maybe most importantly, it acts as a discipline mechanism. It helps protect you, the investor, from making emotional, knee-jerk decisions, especially when markets get volatile.
Right. It stops you from panicking. You're getting carried away. So what kind of specific information actually goes into an IPS? What are the key ingredients?
A comprehensive IPS will typically cover several key areas. It starts with your specific financial goals, like, are you saving for retirement in 30 years? A house down payment in 5? Your kids' education? It should note the priority of each goal and the time frame.
Goals and timelines. Check.
Then it details your investment objectives, often framed in terms of risk and return. What level of return are you aiming for, given your time horizon? And crucially, what's your risk tolerance? How much volatility can you stomach?
Risk-return profile. Okay.
It also needs to outline any constraints. Things like liquidity needs, maybe tax considerations, or regulatory limits we'll probably touch on. And it should mention any strong preferences, like specific asset classes you want to include, or, just as importantly, avoid.
Like ethical considerations.
Exactly, that falls under preferences. And finally, a good IPS should specify how and how often it will be reviewed and potentially updated, because your circumstances can change.
Makes sense. It's a living document, not something you just write once and forget.
Yeah.
Now, digging into those investment objectives you mentioned, risk, return, and liquidity, how do those 3 concepts relate to each other?
Right, those are key. Generally speaking, there's a positive relationship between risk and expected return. To potentially earn higher returns over the long run, you usually have to be willing to accept a greater degree of risk, more uncertainty or volatility.
The classic risk-reward trade-off.
Exactly. Think of it like climbing a mountain. The higher the potential peak, the potentially higher return, the more challenging and risky the climb might be.
Okay. And liquidity, how does that fit in?
Liquidity is about how easily and quickly you can convert an investment back into cash without losing significant value. Now, there's often an inverse relationship between liquidity and expected return.
Inverse. So less liquid means higher return.
Potentially, yes. Investments that are harder to sell quickly, think maybe private equity or some types of real estate, might offer a slightly higher expected return to compensate investors for tying up their money and taking on that illiquidity risk. It's sometimes called an illiquidity premium.
Ah, okay. You get paid a bit extra for the inconvenience of not being able to access your cash easily.
That's the idea. So when setting objectives, you need to consider all 3. Your return target, your risk tolerance, and your need for liquidity.
And how do these different objectives, like, say, focusing on just keeping your money safe versus going for growth, actually drive the investment choices?
They're the main drivers behind your asset allocation. If your primary objective is capital appreciation, you want your money to grow significantly over time, you'll likely allocate a larger chunk of your portfolio to assets like equities or stocks, which historically offer higher growth potential, even though they come with more ups and downs.
Right. Going for growth means more stocks.
If your main goal is capital preservation, you're more concerned about protecting your principal. You'll lean towards safer, more stable assets like high-quality government bonds or cash equivalents.
Safety first.
And if you need regular income, maybe in retirement, you'll focus on investments that generate cash flow, like dividend-paying stocks or bonds that make regular interest payments.
Okay, so the objective really dictates the overall strategy and the types of assets you favor. Now, let's circle back to those investment constraints you mentioned being part of the IPS. What kinds of limitations are we talking about there?
Constraints are basically any factors that limit or restrict your investment choices. They often fall into a few key categories: liquidity needs, regulatory rules, tax considerations, and sometimes unique circumstances.
Okay, let's tackle liquidity constraints first. We touched on needing cash, but what are some practical examples?
Yeah, liquidity constraints relate to your need for readily available cash. There are usually three main reasons. First, you need an emergency fund cash set aside for unexpected events like job loss or medical bills. A common rule of thumb is maybe 2-3 months worth of essential living expenses.
Rainy day fund.
Exactly. Second, you might have specific near-term financial goals, things you plan to spend money on within, say, the next year or so, like a down payment, a wedding, or a big trip. That money needs to be safe and accessible.
Can't risk it in the market if you need it soon.
Right. And third, sometimes investors want to hold some cash for flexibility, maybe to take advantage of unexpected investment opportunities that might pop up.
Okay, so it's a bit of a balancing act, isn't it? Holding too much cash drags down your overall return, but holding too little could mean you're forced to sell other investments at a bad time if you suddenly need funds.
That's the trade-off, perfectly stated. Your IPS should clearly define how much liquidity you need and why, which helps determine how much to keep in very safe, easily accessible assets versus longer-term investments.
Got it. What about regulatory constraints? Do individual investors typically face many regulations?
Generally, individual investors have fewer direct regulatory hurdles than, say, big pension funds or insurance companies, but there are still some rules to be aware of.
Such as?
Well, for example, many countries have regulations limiting how much money their residents can invest overseas each year. In India, for instance, there's the Liberalized Remittance Scheme, or LRS, which sets a limit, currently $250,000 per person per financial year for outward remittances, including investments.
Okay, limits on investing abroad. Anything else?
And universally, there are strict prohibitions against insider trading, that's trading based on significant non-public information. That's a legal constraint everyone needs to respect. But for most day-to-day portfolio decisions for individuals, the regulatory constraints aren't usually the biggest factor.
Right. Taxes, though. I suspect they're a bigger deal. How do taxes act as a constraint?
Oh, taxes are hugely important. They can significantly impact your net after-tax returns, which is ultimately what matters, right?
Absolutely. It's what you keep that counts.
Different types of investment income are often taxed very differently. Interest earned on bonds might be taxed as regular income. Dividends from stocks might get a preferential rate. And profits from sending investments, capital gains often have their own set of rules, sometimes depending on how long you held the investment.
Short-term versus long-term gains, yeah.
Exactly. Plus, your overall tax rate often depends on your income level, your tax bracket. So understanding the specific tax laws that apply to you is critical. Your IPS should factor this in, maybe aiming for tax-efficient investment strategies where appropriate, like holding certain investments longer to qualify for lower capital gains rates, or using tax-advantaged accounts like retirement plans.
So tax planning is a key part of portfolio management, not just something you think about at tax time.
Definitely. It needs to be integrated into the strategy from the start.
Okay. Another term I recall reading about is exposure limits. What's the idea behind those?
Exposure limits are basically self-imposed rules or sometimes regulatory requirements for professional managers that cap how much of your portfolio can be invested in a single thing or a specific category.
Like not putting all your eggs in one basket.
Exactly that. It's about managing concentration risk. You might set limits on exposure to a particular industry sector like technology or energy, or even to a single company's stock or bonds. You might also set limits on broad asset classes, like how much can be in international stocks or real estate.
And how do you decide on those limits?
They should flow logically from everything else we've discussed. Your overall investment objectives, your risk tolerance, your constraints like liquidity, your time horizon, and market conditions. The goal is to ensure your portfolio is sufficiently diversified so that if one specific area performs poorly, it doesn't disproportionately damage your overall results. Regulations for professional managers, like SEBI's PMS rules in India, often mandate certain diversification levels too.
That makes good sense. Avoid letting one bad bet sink the ship.
Now, beyond the financials and the rules, people are individuals, right? They have unique personal values, beliefs. How does that fit in?
Absolutely. That's where unique needs and preferences or idiosyncratic concerns come into play. These are factors beyond just risk and return that are important to the individual investor. Like what, for example?
It could be anything, really. Someone might feel strongly about environmental issues and not want to invest in companies known for polluting. Another person might prioritize social factors like companies with good labor practices or community involvement. Or it could be ethical concerns like avoiding industries involved in alcohol, tobacco, or gambling. Sometimes it's even an emotional attachment, like wanting to hold on to stock in the company they work for, even if diversification principles might suggest otherwise.
Right. Those personal values can really shape investment choices. And this naturally leads into concepts like sustainable and ethical investing, doesn't it?
It does. Sustainable investing, often known by the acronym ESG, environmental, social, and governance, is a major trend. It involves explicitly considering these non-financial factors alongside traditional financial analysis.
Can you break down the E, S, and G?
Sure, environmental criteria look at a company's impact on the planet, things like its carbon footprint, water usage, pollution control, or investment in clean technology. Social criteria relate to how a company manages relationships with its employees, suppliers, customers, and the communities where it operates. Think workplace safety, diversity, human rights. And governance deals with how a company is led and managed, board independence, executive compensation, shareholder rights, things like that.
And the goal here isn't just about feeling good, right? There's a financial argument, too.
Increasingly, yes. The goal is often twofold: to generate competitive financial returns and make a positive impact. But there's also a growing belief, backed by some research, that companies with strong ESG practices might actually be better managed, more resilient, better prepared for future challenges, and potentially positioned for stronger long-term financial performance.
Interesting. So doing good and doing well aren't necessarily mutually exclusive. How does ethical investing differ from this broader ESG approach?
They're related, but often distinct. Ethical investing is typically more values-driven and often acts as a primary filter based on an individual's specific moral or ethical principles. It usually involves excluding certain types of companies or industries upfront.
Like the sin stocks you mentioned, gambling, alcohol, firearms.
Exactly. An ethical investor might say, I simply will not invest in these types of businesses regardless of their potential return or ESG score. It's often a more black and white screening process based on personal beliefs, whereas ESG tends to be a broader analysis of risks and opportunities across environmental, social, and governance factors within various industries. Ethical investing is often more personalized.
Okay, so ESG is maybe more analytical about risks and opportunities across E, S, and G, while ethical is more about applying personal moral filters. Now, to tailor a portfolio properly, incorporating all these goals, constraints, and preferences, you really need to understand the investor inside out. What kind of analysis goes into that?
You're right, a deep understanding is key. This typically involves several layers of assessment. First, assessing their specific needs and requirements, their goals. Second, analyzing their current financial position. And third, something called psychographic analysis, which delves into their attitudes and personality towards investing.
Okay, let's start with assessing needs and requirements. What does that look like?
This is about clearly identifying all the investor's financial goals. Are they near term, like saving for a car in 2 years, medium term, maybe college funding in 10 years, or long term, like retirement in 25 years? You need to know the time frame for each goal and also its priority. Is it essential or more aspirational?
Why is the priority and timeline so important?
Because it heavily influences the investment strategy for that particular goal. High priority, near-term goals usually demand low risk, highly liquid instruments because you can't afford to lose principal or be unable to access the money when needed. Longer-term goals, like retirement, allow for more diversification and potentially taking on more risk in pursuit of higher growth, as there's more time to recover from market downturns.
Got it. Goal characteristics drive strategy. What about analyzing their financial position? How do you get a handle on that?
This usually involves gathering and organizing their financial data using personal financial statements. The two main ones are the net worth statement, or balance sheet, and the income expense statement.
The balance sheet, that's assets minus liabilities.
Exactly. It lists everything you own. Assets like savings, investments, property, and everything you owe. Liabilities like loans, mortgages, credit card debt. Subtracting liabilities from assets gives you your net worth, a snapshot of your financial health at a point in time.
And the income expense statement.
That tracks your cash flow over a period, usually a month or a year. It shows how much money is coming in, income from salary, investments, etc., and where it's going. Expenses like housing, food, transportation, taxes. This helps determine if you have surplus income available for investment.
So it's about understanding their current wealth and their capacity to save and invest going forward. Now, this psychographic analysis sounds fascinating. How does personality come into investment planning?
This is a really interesting area. It acknowledges that investors aren't purely rational robots. Our behavior, our personality, our biases, they all influence how we react to market events and the level of risk we're truly comfortable with, which might differ from the level of risk we think we can handle.
So it's about understanding the person behind the numbers.
Precisely. One well-known framework for this is the Baylor-Bieling-Kaiser, or BB&K, five-way model. It classifies investors based on two key psychological dimensions: their level of confidence versus anxiety, and whether they tend to be careful and analytical versus impetuous or impulsive in their decision-making.
Confidence, anxiety, and careful, impetuous. Okay, what are the 5 types this model identifies?
The 5 types are the adventurer, who is confident and impetuous, comfortable with risk, maybe a bit of a gambler. The celebrity, who is anxious but also impetuous, often following trends and reacting emotionally to market noise.
Okay.
Then there's the individualist, who is confident like the adventurer, but careful and analytical, likes to do their own thing. The guardian, who is anxious and careful, very risk-averse, focused on safety and wealth preservation. And finally, the straight arrow, who falls near the middle, relatively balanced on both dimensions.
That's quite a spectrum. I can almost picture people fitting into those categories. And you mentioned these aren't necessarily fixed.
That's a key point. People aren't always rigidly one type. They might exhibit characteristics of different types at different times, often influenced by their recent experiences. For example, after a strong bull market, even a cautious guardian might feel a bit more adventurous. Conversely, a big market crash can make almost anyone feel more like a guardian for a while.
So understanding these tendencies helps tailor advice and, maybe more importantly, helps the investors stick to their long-term plan, even when their emotions are pulling them in a different direction.
Exactly. It's about designing a strategy that aligns not just with their financial capacity for risk, but also their emotional tolerance for it. A plan someone can stick with through market cycles is much more valuable than a theoretically optimal plan they abandon at the first sign of trouble.
That makes a lot of sense. What about life cycle analysis? How does where someone is in life impact things?
Life cycle analysis acknowledges that financial goals, income levels, expenses, time horizons, and therefore risk tolerance tend to change in somewhat predictable ways as people move through different stages of life.
Like stages of a career or family life?
Yeah, typically we think about 4 broad phases. First is the accumulation phase, usually early career, maybe 20s and 30s. You generally have a long time horizon, potentially lower income, but also fewer financial responsibilities, and a greater ability to take on risk for growth.
Okay, focused on building assets.
Then comes the consolidation phase, mid to late career, maybe 40s and 50s. Income is often higher, wealth is growing, but retirement is getting closer. You might still be focused on growth, but perhaps starting to moderate risk slightly.
Building and preserving.
Third is the decumulation or spending phase, which is retirement. The focus shifts dramatically from saving to drawing income from your accumulated assets. Capital preservation and managing longevity risk become much more important. Risk tolerance typically drops significantly.
Off the savings.
And finally, there's potentially a gifting phase later in life where individuals may have more assets than they need for their own lifetime and start thinking about transferring wealth to heirs or charitable causes. This has its own set of planning considerations.
So your age and life stage are major inputs into determining appropriate goals and risk levels. Okay, we've thoroughly understood the investor goals, finances, psychology, life stage. What happens next? How do we connect this to the actual market?
Right. The next crucial step is integrating all that investor information with forecasts about the capital markets, basically. Developing expectations about the potential risks and returns offered by different asset classes going forward.
So matching the person to the possibilities. How do you forecast market returns? That sounds like trying to predict the future.
It's definitely not about having a crystal ball, but it involves making informed, educated estimates, looking at long-term historical risk and return data for different asset classes, stocks, bonds, real estate, etc., provides a valuable starting point.
Using the past as a guide.
As a guide, yes, but not as a guarantee, remembering that correlations and returns can change. Professionals supplement historical data with analysis of current economic conditions, things like inflation, interest rates, economic growth, and try to project how these might influence future returns. It's about forming reasonable, forward-looking expectations.
Okay, so you have the investor profile and you have market expectations.
Yeah.
Now, how do you judge if the portfolio, once built, is actually doing what it's supposed to? That's where benchmarking comes in, right?
Exactly. Benchmarking is absolutely critical for evaluating performance fairly. You need to compare your portfolio's return against a relevant standard, a benchmark, that represents a similar investment strategy or asset mix.
Why is that so important? Can't you just look at the return number?
Well, a return number in isolation doesn't tell you much. Was a 10% return good or bad? It depends. If a relevant market index tracking similar investments returned 15%, then 10% was actually underperformance. If the index returned 5%, then 10% looks great. You need context.
Comparing apples to apples.
Precisely. If your portfolio is mainly invested in large U.S. stocks, you'd compare it to a large U.S. stock index like the S&P 500. If it's global bonds, you'd use an appropriate global bond index. For a diversified portfolio with multiple asset classes, you might even create a custom or hybrid benchmark that blends different indexes in proportion to your target asset allocation.
And choosing the right benchmark is key.
Absolutely crucial. Using an inappropriate benchmark can lead to completely misleading conclusions about performance. And just like the IPS, benchmarks aren't necessarily static. They should be reviewed periodically to make sure they still accurately reflect the portfolio's intended strategy.
Okay, so it's about having a fair yardstick. Now, we've gathered all this info. Investor needs, risk tolerance, constraints, preferences, market forecasts. How does this all crystallize into the actual asset allocation decision?
This is really the culmination point where strategy meets implementation. The asset allocation decision, deciding what percentage goes into stocks, bonds, cash, alternatives, etc., is the direct result of synthesizing everything we've just talked about.
Bringing it all together.
Yes, you're trying to find the specific mix of assets that offers the best potential to achieve the investor's goals, considering their time horizon and risk tolerance, while respecting their liquidity needs and tax situation, and aiming to maximize their expected after-tax return for the level of risk they're comfortable taking.
It sounds like a very deliberate balancing act. So once that target allocation is set, how do you go about actually picking the specific investments within those asset classes? Are there general principles for constructing, say, the equity or debt parts of the portfolio?
Yes, there are guiding principles. When selecting investments for the equity stock portion, you're usually looking for a balance between stability and growth potential that aligns with the overall objectives.
I'll say.
While large-cap stocks from established companies might provide more stability, while mid-cap or small-cap stocks might offer higher growth potential but usually come with more volatility. If income is an objective, you might include dividend-yielding stocks. The overall exposure to equities will depend heavily on the investor's goals, and longer horizons generally allow for more equity risk.
Okay, that makes sense for stocks. What about the debt or bond portfolio?
For the debt portion, a key principle is often matching the investment horizon with the maturity of the bonds. Short-term goals might be funded with short-term, high-quality debt instruments to minimize interest rate risk and preserve capital. The investor's tolerance for credit risk, the risk that the borrower might default, will also determine the mix, say, between super safe government bonds and potentially higher yielding but riskier corporate bonds.
Matching duration and credit quality to the investor's needs.
Exactly. And then you have hybrid portfolios, which intentionally blend asset classes like stocks and bonds within a single fund or strategy. These can provide diversification, potentially smoothing returns, and are sometimes used as investors approach a long-term goal, gradually shifting from a growth focus towards more stability.
The sort of middle ground.
Kind of. And beyond stocks and bonds, portfolios might also include other asset classes, sometimes called alternatives like real estate, commodities such as gold, or perhaps private equity, often with the aim of further diversification or potentially enhancing returns, though these often come with their own complexities and risks.
So each piece has a potential role to play. Now, earlier we briefly mentioned strategic versus tactical asset allocation. Can we revisit that? What's the difference?
Sure. Strategic asset allocation, or SAA, is the long-term baseline target allocation for your portfolio. It's derived directly from your investment policy statement, your goals, risk tolerance, time horizon. It reflects your core long-term investment strategy. Think of FAA as being about time in the market.
A foundational plan.
Right. Tactical asset allocation, or TAA, on the other hand, involves making temporary, shorter-term deviations away from that strategic baseline.
Why would you do that?
The goal of TAA is to try and capitalize on perceived short-term market opportunities or mispricings. For example, if a manager believes stocks are temporarily undervalued relative to bonds, they might tactically overweight stocks for a period, hoping to profit when prices revert. This is more about timing the market.
So SAA is the long game plan. TAA is making short-term adjustments based on market views.
Precisely. TAA operates within the broader SAA framework. If you make a tactical shift, you generally plan to rebalance back to your strategic targets after the perceived opportunity is played out, or if the view changes.
And which one is more important? You mentioned earlier that allocation drives returns.
That generally refers to the strategic asset allocation. There's a wealth of empirical evidence going back to classic studies by researchers like Brinson, Hood, and Biebauer, and later confirmed by others like Ibbotson and Kaplan, showing that the vast majority, often cited as over 90% of the variability in a diversified portfolio's long-term returns, is explained by its strategic asset allocation policy, not by specific security selection or market timing attempts through TA.
Wow. So getting that long-term SAA right is really, really crucial. Now, markets don't stand still. Assets go up and down in value. How do you ensure the portfolio actually stays aligned with that target SAA over time?
That's where rebalancing comes in. It's a critical part of ongoing portfolio management.
Rebalancing. What does that involve exactly?
It's the process of periodically buying or selling assets in your portfolio to bring its allocation back in line with your original strategic targets. Because different asset classes grow at different rates, over time, the portfolio's actual mix will naturally drift away from the intended mix.
So if stocks outperform bonds for a while,
your allocation to stocks will grow larger than your target, and your bond allocation will shrink. Your portfolio might become riskier than you originally intended. Rebalancing addresses this drift.
how do you do it? Sell the winners and buy the losers.
Essentially, yes. Using your example, if your target was 60% stocks and 40% bonds, and market movements pushed it to 70% stocks and 30% bonds, rebalancing would involve selling some of the overweight stocks and using the proceeds to buy more of the underweight bonds, bringing you back to your 60-40 target.
Okay, and how often should you rebalance?
There's no single right answer. It depends. Your IPS should ideally define a rebalancing policy. Some people rebalance on a fixed schedule, like quarterly or annually. Others rebalance based on tolerance bands. They only take action if an asset class drifts beyond a certain percentage range, say more than 5% away from its target.
What are the pros and cons of doing this? It sounds like disciplined, selling high, and buying low.
That's the main benefit. It enforces discipline and helps maintain the portfolio's intended risk profile. By systematically trimming winners and adding to losers, you're preventing the portfolio from becoming overly concentrated in assets that have recently done well and might be due for a correction, and ensuring you buy assets when they're relatively cheaper.
But are there downsides? Costs?
Yes, there are definitely considerations. Rebalancing isn't free. There are potential transaction costs like brokerage fees. More significantly, selling appreciated assets can trigger capital gains taxes, which eats into returns.
Ah, the tax impact again.
Exactly. Also, for certain investments that aren't very liquid, like maybe private real estate, rebalancing can be difficult or costly to execute quickly. And there's always the opportunity cost the asset you trimmed might continue to outperform, or the one you bought might continue to lag for a while. So the decision on how often and how tightly to rebalance involves weighing the benefits of risk control against these potential costs and difficulties.
It's always a trade-off, isn't it? This has been incredibly insightful walking through the entire process. So just to wrap up, what are the absolute key things our listeners should take away from this deep dive on portfolio construction?
I think the main takeaways are these. First, having a structured, disciplined process is absolutely essential for successful long-term investing. It's not about guesswork or hot tips. Second, that process really starts with the critical decision of strategic asset allocation.
The foundation.
Absolutely. Third, that allocation must be guided by a personalized investment policy statement, your IPS, which clearly documents your unique financial goals, your genuine tolerance for risk, and any constraints or preferences you have.
Know thyself, investor.
Precisely. Fourth, you need to understand not just your goals, but also your current financial standing and even your psychological tendencies when it comes to money and risk.
And finally, remember that portfolio management is not a set-it-and-forget-it's activity. It's an ongoing loop involving monitoring, performance evaluation against appropriate benchmarks, and periodic rebalancing to keep things on track with your goals and adapt to changes.
That's a great summary. Understanding these principles really does provide a powerful framework, whether you're managing your own money or working with a professional. It helps you make much more informed decisions.
And with that, maybe here's a final thought for you, the learner, to chew on. We talked about those different investor personality types from the BV&K model, the adventurer, celebrity, individualist, guardian, straight arrow. Reflect on those. Which one, or maybe which combination, do you think resonates most with you? And how might understanding that aspect of yourself influence how you approach building your portfolio to meet your own goals and stay within your true comfort zone for risk?
That is a fantastic question for self-reflection, a really practical way to apply what we've discussed. This deep dive should definitely give you a solid foundation, and hopefully it sparks curiosity to maybe explore some areas further, like specific asset classes or different rebalancing strategies. Thanks so much for joining us on the deep dive.